Hello everyone, my name is Ronelyn Rola from BSA 3C, and I'm going to discuss a comprehensive problem in Chapter 26, Introductions to Liabilities. Our second comprehensive problem is all about contingency. And when it comes to contingent liability, the key is to know when to accrue and disclose, or just disclose, or perhaps neither. And now, we will answer a problem of Dwayne Company. Dwayne Company, a manufacturer of ball pen, has had a lawsuit filed against it by Vic Incorporated, another manufacturer of ball pen. The suit alleges patent right infringement by Dwayne Company and asks for compensatory damages. For the following likely situation, determine how Dwayne Company should report the information concerning the lawsuit. The choices are A. Accrue and disclose, B. Disclose only, C. Accrue only, D. Neither accrue nor disclose. So before we will discuss the cases or the following cases, I'll explain to you when you use the accrue and disclose, disclose only, and so on. So A. Accrue and disclose. So when do you use this? You will need to accrue and disclose when the loss is probable or likely to happen, and the amount of the loss can be reasonably estimated. So when the loss is probable and the amount can be reasonably estimated, you will need to accrue and disclose. This means that the company must both recognize the liability in the financial statement and provide additional details about it in the notes. So what does it mean? So when you accrue, you record the liability as an expense, and disclose, you will provide more details about it in the notes to the financial statement. B. Disclose only. When do you use this? So now, what happens if the loss is reasonably possible? Meaning, it might happen, but it's not certain. Or, the loss is probable, but the amount cannot be estimated. So in this case, you only disclose, but you do not accrue. Meaning, you will disclose or mention the potential issue and its possible financial consequences in the notes to the financial statement. However, there is no accrual, meaning you will not record the liability in the financial statements. C. Accrue only. So this is a rare case, but it can happen. Here, a company might accrue the liability but not disclose it. This is typically not allowed under normal accounting standard, but could apply when the liability is certain and measurable but doesn't need detailed disclosure. And lastly, neither accrue nor disclose. Sometimes a loss is remote, meaning it's very unlikely to happen, and even if it does, it won't significantly impact the company finances. In this case, do nothing, no accrual and no disclosure. You simply ignore it in the financial statement and don't disclose it. And now, let's go through to the following cases. So, number 1, Dwayne Company's legal counsel estimate that an infringement case may result in a loss of $2 million, but consider the likelihood of losing the case as a remote. So, the case number 1 is considered as a contingent liability. The legal counsel estimate of $2 million loss, but consider the likelihood of losing the case as a remote. So the rule is, if a loss is remote, it doesn't need to be recorded or disclosed. So our answer for this is D. Neither accrue nor disclose. Number 2. Dwayne Company's legal counsel is convinced that the likelihood of losing the case is probable. The potential amount of the loss is estimated to be 2,300,000 pesos. So this one is a provision. The entity should recognize the liability at 2.3 million and disclose it in the financial statement. It has a present obligation and the amount can be measured reliably. So if the loss is probable and the amount can be reasonably estimated, the company must accrue it and disclose it in the notes to the financial statement. So the answer is A. Accrue and disclose. Number 3. Dwayne Company's legal counsel estimate that the infringement case may result in a loss of 2.4 million, but considers the likelihood of losing the case as reasonably possible. So this is a contingent liability. The legal counsel estimate a 2.4 million loss and consider the likelihood of losing as reasonably possible. So do not recognize but disclose the contingent liability in the notes of the financial statement because the likelihood of the outcome is possible, not probable. So if a loss is reasonably possible, it should only be disclosed in the financial statements, notes of the financial statements, but not accrued. So our answer is letter B, disclose only. Number 4. Dwayne Company's legal counsel is convinced that the likelihood of losing the case is probable. The potential amount of the loss, however, is currently undeterminable. So this is a contingent liability. Though it's meet the definition of a liability, meaning there's a present obligation that is probable, it does not meet the recognition criteria because the amount cannot be reliably measured. Hence, the liability is not recognized but disclosed as contingent liability in the notes of the financial statements. So if a loss is probable but cannot be reasonably estimated, then we only disclose it, no accrual. So, letter B, disclose only. Case number 5. Dwayne Company's legal counsel is convinced that the likelihood of losing the case is probable. The potential amount of the loss based on a reliable evidence would be as follows. 20% that the liability would be 1.6, 50% that the liability would be 2,000, 30% the liability would be 2.4. So, IAS 37 requires provision to be measured at the best estimate expenditure required to settle the present obligation at the end of the reporting period. This remains to be a matter of judgment by the entity's management, though the standard suggests various ways of measuring the amount. So the method that we will use is the expected value or probability weighted method. Then our solution would be like this. 1.6 million times 20%, we have 320 pesos. 2 million times 50, we have 1 million. 2.4 times 30%, we have 720, and you add that 3 items and we come up with an answer of 2,400,000 pesos. So for this scenario, expected value or probability weighted was used because the standard suggests that if the obligation relates to a single obligation, the best estimate would be the most likely outcome. But then again, in actual scenario, management judgment will still prevail, which the standard permits. But since the problem is silent, we follow the assumption provided by the IAS 37. Therefore, this is a provision, and the entity should recognize the liability at 2,040,000 pesos and disclose it in the financial statement. It has a present obligation and the amount can be measured reliably. So our answer is letter A, accrue and disclose. And case number 6. Dwayne Company legal counsel is convinced that the likelihood of losing the case is probable. The potential amount of the loss based on a reliable evidence would be around 1.5 to 3,000. So using the midpoint of the range or possible outcomes, we're getting the midpoint or the average of the upper and lower limit of the range to get the best estimate of the liability. So the standard requires that in case where a continuous range of possible outcome is likely as any other, the midpoint of the range is to be used. And the legal counsel says that the loss is probable with an estimated range of 1.5 to 3 million pesos. So using the midpoint rule, the best estimate is 2,250,000. So how did we come up with that answer? So you add 1.5 plus 3,000. So we have 4,500,000. You divide it by 2 to get the midpoint. So we have 2,250,000. And since the loss is probable and we can estimate it using the midpoint, so we must accrue it and disclose it. So the entity should recognize the liability at 2.250 million and disclose it in the financial statement. So our answer should be A, accrue and disclose.
For the next problem, this one is about warranty premiums and bonus calculations. So we'll break it down step by step so we can understand how to compute these amounts correctly. So for this problem, we have financial data for Bosch Company for the year end of December 31, 2021. So Bosch Company sells washing machines and ovens. And we need to determine the following: the estimated warranty payable, estimated premiums payable, the adjusted net income, and the bonus calculations both before and after tax. So let's go through each one carefully. So first questions ask, what is the estimated warranty payable? So the company sells washing machines that come with a 3-year warranty. So the estimated warranty cost per unit is 150 pesos. And they sold 1,200 machines. So the total expected warranty is to get that, we need to multiply the 1,200 machines that was sold and 150 pesos cost per unit. So we get the total expected warranty cost of 180 pesos. However, the company only recorded 85 pesos as the warranty expense. So this means that they still have a liability for the future claims. So to find the remaining liability, we need to subtract the total expected warranty cost, which is amounting to 180,000 pesos by the 85,000 pesos which was recorded. So we get the answer of amount of 95,000 pesos as the estimated warranty payable. So why do we record this? So under past 37, a company must recognize a liability if 1. There is a present obligations, moto ang warranties. So number 2, it is probable that an outflow of resources will happen. 3. The amount can be measured reliably. So since the warranty cost meets these conditions, we need to record it. So for next question, number 2, what is the estimated premiums payable? So Bosch Company runs a promo where customers earn 1 coupon per peso spent on ovens. So 400 coupons can be exchanged for a t-shirt. And then it is said also that the company buys t-shirts for 45 peso each, and customers also pay 20 pesos when redeeming. So, since the total oven sales were 1,200,000 pesos, so customers got 1,200,000 coupons. However, it is stated there in the problem that the company estimates that only 60% will be redeemed. So, we need to multiply the 1,200,000 by 60%. So, we get the 720,000 coupons. Mo ni ang estimated nga 60% nga ma-redeem. So, out of this, nagisaad po diha sa problem, it is stated there that 500,000 coupons have already been redeemed. So, we need to subtract that from 720,000 coupons. Then, we can get the amount of 220,000 as the new balance coupons. So, since 400 coupons equals 1 t-shirt man, so the remaining number of t-shirts to be redeemed is 220,000. So, yeah, mao ba ito ang new balance, no? 220,000. So, i-divide na to by 400. So, we get a total of 550 t-shirts. So, it is stated there in the problem that each t-shirt costs 45. So, 550 times 45 pesos, we get the total of 24,750. But, remember, Customers also pay 20 pesos per t-shirt if they redeem it. So the company only covers 550 times 20. We get the amount of 11,000 pesos. So i-subtract na to sa 24,750. We get the amount of 13,750 pesos. So mao ni siya ang atong estimated premiums payable. So again, under past 37, this is a liability because it's an obligation the company knows will happen. So for question number 3, what is the adjusted net income during 2021? So to determine the adjusted net income, we start with the reported net income and they adjust for warranty and premium related expenses. So let's start with the reported net income we have here. 1,935,000. Then we subtract the estimated warranty payable nga 95,000, which is sa number 1, see to the number 1, mao tong 95,000. Mao to kay the company estimated nga ang total warranty cost for sold machine should be 180,000. However, katong 85,000 man gi-record ready ha nga warranty expense, so this means ang katong additional nga 95,000 still needs to be recognized as a day obligation. So mao tong 1,935,000 minusan og 95,000, we have the amount of 1,840,000. So we add back the premium expense that was already recorded. So the company initially recorded their premium expense of 270,000 when they purchased the t-shirts for the premium program. Since this was fully expensed at the time of the purchase, we add it back because we will now account for the actual premium cost properly. So 1,840,000 plus 270, we have the amount of 2,110,000. And then we subtract the premiums that was already paid. So customers have already redeemed the 500,000 coupons, which means that they receive 1,250 t-shirts. Kay 500,000 divided by 400, we have the answer of 1,250 t-shirts. So the company's cost per t-shirts is 25. We computed that as, di ba, 45 pesos ang cost. Minus sa 20 nga dapat i-paid sa customers, we have the amount of 25 pesos. So the cost of the 1,250 t-shirts already given is 1,250 times 25, we have the amount of 31,250. So 2,110,000 minus 31,250, we have the amount of 2,078,750. Then we subtract also the estimated premium payable, which was in number 2, 13,750. Since the company expects 60% of the coupons given, so 1,200,000 times 60% na 720 coupons. So this means that they expect to give away the 1,800 t-shirts. So 720 divide 400, natay 1,800 t-shirts. So since ang 1,250 t-shirts were already given, the remaining t-shirts should be given are 1,800 minus 1,250, we have 550. So the estimated additional premium cost for this is 550 t-shirts. So mo ng 550. So 550 times 25, we have the amount of 13,750. So ang amount ganiya sa balance nga net income, we have 2,078,750 minusan sa 13,750, we have the adjusted net income nga 2,065,000. So that's it for the number 3, adjusted net income. So let's go for question number 4. Assuming a bonus of 20% is given to the president based on the net income, after bonus and before tax of 30%, how much is the bonus? So to answer that, let's determine the bonus based on net income after the bonus but before tax. So let's use the formula B is equals to R times NI minus B. So where B represents the bonus, R represents the bonus rate which is 20%. The NI represents as the adjusted net income which is 2,065,000. So now let's substitute the given values into the formula. So B is equals to 0.20 times 2,065,000 minus B. Next, we distribute the 0.20 to the terms inside the parentheses. So B is equals to 413,000 minus 0.20 B. Now to isolate the B, we add 0.20 B to both sides. So we have B plus 0.20 B is equals to 413,000. So since bonus plus 0.20 bonus is the same as 1.20 B, we rewrite the equation as 1.20 B equals 413,000. So to solve for the bonus, we divide both sides by 1.20. So we come up with the answer of 344,167 pesos, which is option B. And lastly, for question number 5, assuming a bonus of 20% is given to the president based on the net income after bonus and tax of 30%. So, how much is the bonus? So, we use this formula to understand this. The bonus is calculated as 20% of the net income after subtracting both the bonus and the tax. So, the tax itself is 30% of the net income after deducting the bonus. So mathematically, we can express this as B equals to R times NI minus B minus T. So since the tax is 30% of the net income minus bonus, so we substitute T is equals to 30% times NI minus B. So now, plugging in our values, we get B is equals to 0.20 times, open parentheses, 2,065,000 minus B minus 0.30, then times 2,065,000 minus B. So first, let's calculate the tax term. 0.30 times 2,065,000 minus B. So we get the answer of 619,500 minus 30.30 B. So now let's substitute this back to the equation. So B is equals to 0.20 times 2,065,000 minus B minus 619,500 plus 0.30 B. So simplifying the inside the parentheses, so B is equals to 0.20 times 1,445,500 minus 0.70 B. So B is equals to 289,100 minus 0.14. Now, we bring all the terms involving B to one side. So, B plus 0.14 B equals 289,100. Then, 1.14 B equals 289,100. And then, B is equals to 289,100. So, we divide both side by 1.14 to get the B. So B is equals to 253,596. So this is the bonus for the president, which is corresponds to the option letter C in the given choices. So that's it for the premium warranty and bonus calculation. So understanding this concept is essential in making informed businesses decision. Accounting for liabilities, whether they are contingent or related to warranties and bonuses, it plays a significant role in financial transparency. So, proper recognition and estimation of these expenses, it helps businesses stay compliant and financially stable. So that's it for some of the comprehensive activity problems of Chapter 26, the introduction to liability. The first one is a contingency, and the second one is a premium warranty and bonus calculation. So once again, this is Bernadeth Rivera and my partner Ronelyn Rola, and thank you for watching.